And let me start off the discussion by asking maybe first Morris, but then my other colleagues. Morris has said, and many of us say, that a new stimulus program should be a part of the response to limit the spillover from the financial crisis to the real economy. And I would predict if we have a President Obama, as seems likely, that will be probably his first initiative right out of the chute in January. Now, we know that the budget deficit is already heading toward $600 billion or more, even before all this happened. Depending how you score it, there'll be at least a couple $100 billion more in the short run from the crisis response measures. And a stimulus package, to be worth its salt, will be at least another couple $100 billion more. So I would argue it's plausible to think we're looking at a budget deficit of $1 trillion a year in the first year of the new U.S. administration. Question to my colleagues, A, do you agree with that? And B, if you do, what's better for confidence? To have a stimulus package that gets the real economy growing again at the price of budget deficits in heretofore unforeseen terrain, or to try to maintain the full faith and credit of the U.S. government, and indeed the Federal Reserve with its ballooning balance sheet, at the cost of not being able to do so much for the real economy. Morris, let me ask you that, see if others want to chime in, and then we'll open to the group, including responses from the floor to that question, which may turn out to be a highly operationally important one for our new president as he contemplates taking office the day after he's elected in less than a month. Morris.
Well, I guess I just look at the numbers coming in and see what the performance in the real economy looks like. If we continue to have this, enormous turmoil in financial markets and issues of trust and lending from one institution to another, then I think the bank recapitalization and some of those would be higher priority for me. But if you keep getting in employment numbers, all the other indicators get much, much worse, then I think you have to do more than one at a time. But I just wait and see what the numbers look like.
Mike, you did our global forecast with a big emphasis on the U.S. outlook just last week. What's your judgment on whether we enhance confidence or undermine confidence with a stimulus package that pushes the budget deficit to $1 trillion or beyond?
Oh, I think we're certainly going well over $1 trillion. I mean, in the current fiscal year, the $700 billion is going to be mainly on budget. The Fannie and Freddie $200 billion has not yet been expended because they can put that in the form of preferred shares, but they haven't done it yet. We've got the ordinary budget deficit from the normal cyclical stabilizers, and undoubtedly there's going to be financial assistance to state and local governments. There's going to be something more money to support housing and so forth. So I think the deficit by the normal accounting scoring is going to be run to well over $1 trillion. But I think keep in mind the ratio of the debt held by the public in the United States, which includes mainly foreigners, to GDP is around 40%. And we're talking here about 10% of GDP at $1.5 trillion. So I don't think the figure is going to be all that frightening. And a lot of it is presumably going to be exchange of assets rather than outright expenditure. I don't think we need to worry about the inflationary consequences in the near term if the economy is going into the tank. I would add that around the world we've had a lot of experience with these financial crises and bank recapitalizations, and if we were able to get out of this one with 10% of GDP, as normally scored, we'll be doing quite well, and we may get a fair bit of that back. The worry would be it gets to be a good deal greater than that.
Adam, and then Bill.
10, 15 years ago, I went through this with the Japanese government at some length. And the fiscal stimulus lessons you can take from there are several. First, it does matter what you spend it on. So when people in the Obama campaign or elsewhere talk specifically about high return infrastructure projects, when they talk about targeting state and local governments who are not going to be able to do hospitals and construction and things like that in the short term, that is actually a worthwhile discussion to have, versus bridges to nowhere in Alaska, which don't necessarily pay off. There's also a case to be made, and again, CBO has to get into the details of this, but there's a case to be made that you do want to do direct public spending, some of the things Morris talked about, but in other ways versus tax cuts. Because tax cuts you're going to have trouble reversing later, and they may get dissipated in terms of their multiplier effect. The second thing is there's always going to be a lot of chatter about people saying fiscal stimulus won't work. What we established analyzing Japan is that when it is done actually properly with a commitment from the government, it does work. So this is just the closing part of Morris's great talk. Not so much that I want everyone to go out there and spend all the things he suggested that might be done at once. That would probably be a little much. But the opposite point, that if we do judiciously spend and take action, it will have an expansionary effect on the macroeconomic policy. On the macroeconomy, we don't need to despair. Final point, just to pick up on Mike in terms of debt. As he points out, the national net debt of the U.S. is relatively low by international standards, and we have to look at this in a global context. There are an awful lot of countries that are going to be running rather large deficits in the coming couple of years. I was already forecasting that several months ago, because you've got countries that have got, as Robert Zellick spoke about in this room yesterday, food and energy problems for their populace that they're going to have to subsidize. You've got countries that have been quite reasonable on the fiscal side, like Brazil, who will have the option to exercise their fiscal policy in a judicious way. And if we're in a situation of recurring financial panic, which I'm beginning to fear we're in, that actually is a good thing if you start driving up the long end of the yield curve, because then everybody who's panicking about getting in only into treasuries on the short end starts having more reason to get out of the short end treasuries and put more money into the system instead of hiding it into the basket.
Are you responding to that?
I just wanted to make a brief comment that perhaps if we have an Obama administration, a bridge to nowhere in Alaska would have a certain degree of attractiveness.
It seems to me that the crisis is making a transition from a crisis to the banking sector to the crisis of the real economy. The banking sector now, 6 banks comprise 2/3 of all the assets. Bank of America, JPM, Citi, Goldman Sachs, Morgan Stanley, Wells Fargo. So basically, it's only you've only got really too big to fail banks, which account for the bulk of the system. So the system itself, in a sense, is in considerably less jeopardy. What's happened is the price of that is that the crunch is occurring in the real economy. That makes you, I think, more open to the notion of fiscal stimulus if needed. Secondly, the accounting of the TARP should be minimal. If Ex-Im Bank, for example, any public loans like this, you do a probability estimate of what the value loss is. The TARP, some people say, is the mother of all carry trades. The government borrows at 2%. It buys up assets that are paying 6% at 50 cents on the dollar, so it's making 12%. So if it's anywhere near that, you don't have to write down $700 billion on the outlay.
Okay, the floor is open for questions, comments on any of the above. Yes. Go to the mic and identify yourself and hold forth.
Hi, Jim Hansen.
From?
Consultant at the World Bank. What about mixing the stimulus and the mortgage straightening out? How about, for example, agreeing to pay some parameters of interest on the existing mortgage loans for some people? This would make the mortgage assets better, and it would provide stimulus to those people who were maybe going to pay the mortgage. This seems to me a lot easier than trying to straighten out the foreclosure problem.
Okay. Morris or anybody else? Simon?
I think that's a thank you. Very good question, and I would emphasize. I think Morris said it quite clearly the first time through, and I emphasize that we shouldn't lose sight of the mortgage problem. And I think this is the death spiral we have with foreclosures and forced sales and falling house prices, then feeding back into more foreclosures, is really very important. And anything that you can do to break that, I think, would be strongly complementary to the bank recapitalization and to some kind of fiscal stimulus. I think on the mortgages, I'm leaning more towards a more micro approach of actually trying to beef up the kind of restructuring and loan loss minimization efforts that actually there's a lot of good people in Fannie Mae and Freddie Mac with a lot of experience on this. That used to be an important part of their business. They now work for the government, as you know. And you could easily scale that up. I mean, it's messy. It takes a long time. I think we're talking about 2 to 3 years to really turn it around. But if you could show people through a very credible micro process that you could reduce the losses there, I think you could tie that up also with various ideas for buying up the mortgage-backed securities, repackaging them. So you take some of the good loans and resell mortgage-backed security based on those, and you take some of the bad loans. And do what you can to minimize the losses. I think a rent-to-own program in that context could be interesting. We'll have some proposals out about that in a couple of days. I'm a little less optimistic than Bill, I think, about the costs here. I think there's going to be some very, very real costs. I think particularly if you don't stop the falling house prices, I think a lot of these securities will further decline because I think the real economy is heading in a very difficult direction.
Jessica? Here's a mic coming.
Thank you. Jessica Einhorn, Scythe. As Morris mentioned at the end, regulatory policy has a big role to play, but there were other causes. And with this panel, I wouldn't want to miss an opportunity to ask the general question. The BIS essay this year pointed to the fact, took a very strong view, that actually what we had was a monetary phenomenon, that there'll always be governance problems and management problems and herd behavior, financial crises will come. But that this was a fundamentally monetary problem and that it was a monetary problem caused by a positive supply shock that was basically overlooked and never discussed in the form of low prices that were coming from Asian products. It was very interesting because it was no longer a discussion about whether the Fed should have moved on asset price inflation. It was instead an argument that it was really a monetary phenomenon and that the low inflation that we had disguised a positive supply shock. And just as you respond to a negative supply shock in ways that I don't have to describe, here a positive supply shock would have said that even with inflation at 2% and growth, you should have raised interest rates and engineered a recession. Leaving aside the political economy of trying to do that in the United States, I'm just wondering if Morris, Michael, and others on the panel have a view in response to the BIS essay on this question.
Well, we have certainly argued for some time that the international position of the United States was unsustainable and did require a slowdown, if not a recession, a slowdown in the growth of domestic demand with a switch to reducing the external imbalance and hoping that the two balanced out. We've gotten the second part of it. What's interesting is that over the last year, the entire growth of U.S. output has come from the expansion of our trade position, the improvement in our trade balance. Domestic demand has essentially been flat for the last 3 quarters, but we've been saved from recession by the good part of that adjustment, the expansion of our external trade position. Now, obviously, it's gone a bit too far on the domestic side. But Mike or Simon, others, Adam, want to elaborate on that?
Well, I've argued for many years that central banks should take some account of asset prices when they go up as well as go down. But that said, I think I would say, well, in the clear light of hindsight, it probably would have been better if monetary policy in the U.S. in particular were not quite so easy for quite so long between 2003 and 2006, or alternatively, if the Fed had started to tighten somewhat earlier or more aggressively. wouldn't have avoided the problem, but presumably would have had less of a bubble in house prices and in residential investment if, say, the federal funds rate had hit 5.25% in August of 2005 rather than in June of 2006. So I think it would have helped. But that's a judgment which is, I think, much easier to make in hindsight than it was at the time. And I know I was not pounding the table in that period saying the Fed should tighten sooner and faster. And I can't recall anybody else who was pounding the table in that way either. So I think we need to take that as another lesson that this is an issue to watch very carefully. But quite frankly, I've been astounded at the magnitude of the financial crisis that has emerged out of this real estate problem. There's something else which is, I think, going wrong in the functioning of the economic system beyond the fact that monetary policy was a little too loose for a little too long.
Let me amplify Mike a moment. My old co-author, Ben Bernanke, wrote a paper with Mark Gertler for the Jackson Hole Conference back in '99, arguing that central banks should not burst asset bubbles. I since did some empirical work, as did some others, looking at that question and came to the same conclusion. You cite the valedictory BIS report of Bill White, and the BIS had been harping on this idea for many years. They were the ones who came closest to Mike's characterization of pounding on the table. Yet whenever any Fed official or anyone independent confronted them and said, well, how much do you really want us to raise interest rates right now? They would always quail and say, not really. We just want to lean against the wind. You should be more cautious. Yes, I know he's there. And that's the record. And so the question was, despite the number of person years, I should say, that they spent on research trying to prove there were connections between monetary aggregates, measures of global liquidity, measures of credit booms, and outcomes in the real economy, there is no paper out there, despite huge amounts of resources spent by the BIS and European central banks, that makes that case credibly. And then you have to ask what's necessary and what's sufficient. There were loose monetary policies, but could you have had a huge real estate boom taking the American housing market from 64 to 69% home ownership if you hadn't had this enormous relaxation of lending standards? Could you have had AIG and all these other firms holding on to this garbage had there not been such blind faith in the credit agencies who had conflict of interest and sheer incompetence, which, as Morris points out, were entrenched by the Basel process? Could you have had all these things go on without salutary neglect by the Fed? The Fed is not blameless simply on monetary policy, as the late Ned Gramlich pointed out very articulately at the end of his career. It seems to me that you can get sufficient explanation for what's going on a very long way solely with the regulatory failures without having to resort to the monetary question. And finally, you can flip it around and look at all the other countries in the world that have had Ireland, Spain, UK, that had independent monetary policies of the U.S., and where the ECB has hardly been a loose cannon compared to the Federal Reserve on any sense in terms of aggressively easing policy, and yet they still had the same real estate booms, and they are now having the worst busts. So no matter how many times people say this, ultimately it was a regulatory failure, not a monetary failure.
Okay, Simon and then Morris.
I agree with Mike and with Adam on these underlying weaknesses, but I would stress that the severity of the crisis which we're facing now is far beyond what one would have expected and what we did expect, given these underlying features. And I would stress, and I have a paper I would be delighted to send you or to tell you where to find on the internet, where we go through the sort of how confidence was eroded over the past 6 months, particularly over the past month. And I think it was a sequence of relatively small, compared to these big picture issues, relatively small missteps, particularly in the way they handled Lehman and then AIG. And the way in which that was perceived by the market and the way in which the expectations of creditors were affected. And this is really shocking that we have created a financial system in which confidence turned out to be so precarious, and now it's been severely undermined. It's very hard to put it back together. So measures that 6 months ago could well have been decisive, for example, TARP of this size 6 months ago, I think would have had much more effect. Now it's seen as, I think the New York Times called it a pebble in a stormy ocean this morning. And that is how a lot of people are feeling. And of course, the confidence has been undermined not just in the United States but globally. And now people are worried not about solvency but about leverage and about who has to roll over the debt when. And at least to me in this paper, and I apologize if anyone is at all offended by the analogy, but we argue it very much reminds us of the Asian crisis, 97, 98, where there's a lot of self-fulfilling aspects. And after things have collapsed, you say, oh yes, of course it had to collapse. But it's not clear in many instances that it really had to collapse. Sure, there's vulnerabilities, and when you're attacked, when there's a speculative run, vulnerabilities do appear. And that, I think, on building on these weaknesses, which are clearly there, that is why we're facing really quite a dire situation today.
Morris?
Well, I would put emphasis on misguided assumptions about house prices. I think they'd gone up by a lot, and people thought they would keep going up, maybe not as much as before, but everybody was into that. At the risk of totally destroying my credibility, I have to say I bought a house, a larger house, in 2005. Thought about it a little bit. Went to my unpaid financial advisor, Mr. Mussa, asked him what he thought. He not only thought he thought my mortgage was too small. He said I should get a bigger mortgage, which I did. So, there's something to this. Look around, your neighbors are getting apparently wealthier, you're not. So, it's when you put all the other stuff aside, I think that was not independent of low mortgage rates. And other things, but there's something to that when it's been going on a long time, and it's not going to keep going on forever. But you think, well, another couple of years will be enough for me, and you do it.
I'm delighted to report, as a result of all this, Morris now will be spending several more years working at the Institute than we had originally turned out, and Mike and I worked that out very skillfully when we responded to Morris's questions a couple of years ago. Just one more comment on Jessica's original question, the positive supply shock from China and the like. We should not forget the other side of that supply shock as well, the huge buildup of reserves in China and elsewhere, which led to huge capital inflows to the U.S., which, all things equal, kept interest rates lower and, at least to some extent, encouraged the kind of lending and borrowing behavior and monetary policy which contributed to the crisis. Right. So, and we differ even at this table as to the extent to which that international dimension was important. But it may be that the unsustainability of the U.S. external imbalance and demand for foreign credit that we've all railed about now for a decade shows up in this way, rather than a collapse of the exchange rate and the typical currency crisis that had been the mechanism in other countries. We're doing more work on that. We've got a big event coming up on that in a couple of months. But that, too, I think, has to be added to the list of possible underlying causes. Okay, Lex?
Brookings Institution. Morris, your 10 planks for regulatory reform didn't include anything about size. Bill has pointed out about how we now have a few mega banks in the U.S. that are, I would say, obviously too big to fail. Isn't there something along these lines? And also, you mentioned the Fannie and Freddie Mae. You say they should be broken up and privatized. I mean, doesn't that, by analogy, mega banks should be broken up and privatized, or before they're nationalized?
Well, yes. I mean, I think that the growing concentration that you have in the banking system is, other things equal, you'd like it less. But when you find institutions that are going down, and someone comes with their checkbook and says, "Well, I'll buy it, and you won't have to lay out as much money from the public purse," I think all things considered, that was a reasonable deal. I mean, if you figure what would you have done with Merrill if nobody came, what would you have done with Bear Stearns, what would you have done with WAMU? Yes, the cost of that, but I think we'll have to worry about that. We'll have to worry about that later. But I don't. At least I wouldn't have gone forward and said, "Nope, can't do it. Can't tell Mr. Crockett and his colleagues at J.P. Morgan, no deal. They'll be too big. Can't do anything." So that's some of the trade-offs I think you had to make. Again, if you had one of these orderly resolution regimes, you might have a little more time to go look and see who you could get as a buyer and what you would do. But when you do it on a weekend and you're very worried about what the effects are in the market, it's kind of not only who's ready to come up with a check, but who's ready to come up with a check before the Asian markets open in a day or so. So it doesn't give you a lot of choices.
Okay, Stape?
Stapleton Roy, Kissinger Institute. Could some of you comment on whether, if long-term capital management had not been rescued, but had been permitted to go down, would there have been any salutary lessons learned from that might have enabled us to avoid the worst of the current crisis?
Who wants to do that? Mike? Morris? No.
Well, this is the problem of where leads the road not taken. And there's in general not a good answer to that. I think that we probably would have learned something about the necessity to wind up long-term capital's derivative book. They had $1 trillion of gross positions, and the way it was handled meant that somebody just took over those positions, so there wasn't any necessity to test the system as to how all of that would be resolved if they went into insolvency. That said, at the time that LTCM went down, credit default swaps were not a big part of the derivatives market. And that's the part of the derivatives market which seems to be particularly involved at present. The credit default swaps for Lehman Brothers and so forth, and AIG, they're creating an enormous amount of nervousness. So I think I probably favored letting LTCM go into bankruptcy on the grounds that we've had a lot of brokerage firms fail over the years. In 1975, we wiped out a third of the securities industry with the recession, inflation, and the end of fixed commissions trading. And we killed off Drexel Burnham Lambert and Kidder Peabody and many of them. And, as I put it, we're no longer listening to E.F. Hutton. We're no longer thanking Payne Weber. I mean, these things have gone the way of all flesh. So the move to support LTCM's restructuring and was sort of what got us in some sense into Bear Stearns. And maybe if we hadn't done that, Bear Stearns would have been operated differently. I don't know, but it's like that's the road not taken. And so it's very hard to say, well, it clearly would have been better to have done it another way. Just as, maybe Bear Stearns should have been handled differently, and they should have saved Lehman Brothers. Well, I don't know.
Morris?
Well, Stape, I think it depends a bit on your kind of theory of regulatory reform. If you believe that you need a big mess to get things going on the reform front, and I'm a believer in that. I don't wish for it, but I think that's the reality, that if you get off close only counts and horseshoes, if LTCM had not been saved and if it turned into a big mess, I think we probably would have had a little faster action on an orderly closure rule, maybe something on the OTC derivative markets, and there would have been more public outcry for doing something. I think that's the small ray of hope in the current situation. Things are so bad that it's actually become an issue that people notice, and I think people will not want to have this happen again, and I think it will drive some substantial regulatory reform. Whether it will be the right things, I don't know. But there will be a rush to do something. So, in a way, if you'd not done something with LTCM and you got by with little damage, I don't think it would have mattered very much. But if it was a mess, I think you would have had something.
Let me ask my colleagues a related question. There's now pretty widespread agreement, I think, that one of the biggest mistakes our authorities have made in responding to the current crisis was to let Lehman fail. Do you agree with that? And if not, why not? Bill?
Well, I think it does seem to be that it has been the trigger that has made this thing really go worldwide. And of course, the proximate fuse in that was the breaking of the buck, the money market fund that was holding Lehman. Now, it's interesting to think about how we got Lehman. I think there was this theory that, like the contagion in the 1990s crises, when Argentina, as you'll recall, pulled the plug, people were pleasantly surprised that the world did not fall apart. And they attributed the fact that it didn't to the fact that Argentina had been twisting in the wind for months and months, and so everybody had time to prepare. And I think the Fed made the judgment, A, that you need to draw the line somewhere against moral hazard, and B, that because Lehman had been twisting in the wind for so long, that anybody who had positions had plenty of time to position themselves. Well, if they had to do it over again, I'm not sure. I think they probably would not do it over again just to avoid this next plunge of what has happened. And so, in a sense, you could say, in drawing the line on too big to fail, they drew it a little bit too high.
Boris?
I guess I disagree with that. I think when the Lehman case come up, you had unpleasant alternatives, but I think it was necessary to try and draw the line. Now, of course, the line didn't last very long since AIG came immediately thereafter, so that was a bit of a problem. But there are some problems that are specific to unwinding of Lehman, but I guess I think the general loss of confidence in things really relates to the whole string of them. You've had, many of the firms that are really regarded as the hallmark of successful capitalism on the financial side in the United States, and you've just seen them under pressure. Some failed, some had to be taken over, and I think the succession of that has caused the loss of confidence. So again, given the two choices you had, put public money in or put it into bankruptcy, I too would have let Lehman go, although I agree it hasn't been costless.
Bill, quick response?
Just the thing, and there are distinctions, the treatment of the shareholders versus the treatment of the bondholders. To me, the key thing on Lehman was just the opposite from Bear Stearns. You did not have, or just the opposite from Fannie Freddie, even more extreme. The credit holders, the bondholders, took the hit. So it seems to me that just in the very, differentiation of the treatment, it was a very expensive experiment.
Okay, in the back.
Leah Liu from Voice of America. We just talked about the international dimension to the causes of this financial crisis. I'm just wondering if you can talk about the kind of role China can play and what it will possibly do in help stabilize the global financial markets. I think it's interesting to point out that the Chinese Premier Wen Jiabao said, I think the other day, that China's financial system is sound and has kept the momentum for rapid growth. And he said, for a country as big as China, is the biggest contribution to help maintain this kind of rapid economic growth. So,
well, our colleague Nick Lardy is not up here. We just published his essay on financial repression in China, which suggests that the Chinese financial system is not all that robust and sound, though it's true it's not going to face a crisis of the type we have here because of various, shall we say, institutional and structural constraints on the outbreak of a bank panic in China. But see if any of my colleagues want to respond to that. Mike?
Well, we made our financial system quite robust and sound for about 30 years by repressing it. I mean, what you do is you put a ceiling on deposit rates, and you prevent extensive competition amongst depository institutions. You give them a special niche so that they are virtually assured of making profits, and then you don't have a lot of problems with bank failures. If you have a more competitive, flexible system, then there's a tendency for banks to say, well, we've got the magic wand, we can wave it over pieces of paper and make them more liquid, and we can thereby raise their value and make a profit off of that. But the danger is that you create risk that when opinion turns, prices crash. But if you repress the system the way the Chinese do, you can keep the banks in business, and the government, if necessary, can, as the Chinese government has on several occasions, pump a lot of money into them. So soundness is not the only aspect of the financial system that one wants to worry about.
On the broader question of China's possible contribution to a resolution of the crisis, we have an op-ed be in the Washington Post tomorrow, which looks at the upcoming G7 and IMF meetings this weekend and suggests that now that the crisis has clearly gone global, we need a response that will also have a big global dimension. Part of that will be, at least in some of our views, a global stimulus program, because growth is slowing everywhere. It is quite clear that the effects of the financial meltdown are now spreading into the real economies almost everywhere, most obviously in Europe, but even to some extent in Asia. So there's a need for the big countries, the G7 augmented by at least the 5 or 6 major emerging markets who should be invited to the full G7 finance ministers on Friday. There's a need for that group to do some coordinated steps on the regulatory and supervisory side, but also to help restore confidence by announcing they're all going to move to strengthen the world economy. In the Chinese case, that clearly would call for fiscal stimulus, given the strong position of the budget, given the obvious need to expand domestic demand, particularly consumer demand, given the strong position of the budget and the need to rebalance the Chinese growth composition. So, at least in my view, China could play a very big, very constructive role in helping the world come out of this crisis. Okay, last question.
Larry Promisel from the World Bank. A conventional admonition when it comes to regulation and supervision is that you should do no harm. I think most of the planks that you proposed, Morris, are consistent with that principle, but let me ask about one in particular, and that is raising the minimum capital ratios. You're talking about 12 to 14% minimum, given that some banks, some institutions will want to be above that to get better credit ratings. It could be 15, 16%. I've heard people talk about numbers of 20%. You're coupling that with improvements in risk management in a number of ways. Obviously, risk management will never avoid all problems, but a lot of the things you do will enhance risk management. Given that there's often an overreaction to crises, policy overreaction, how would you assess the risk that we will be embedding in the financial system required capital that is just too high, that will be difficult to reverse, and that will lead to not sufficient risk being taken over the long run?
Well, I guess when I think about what's going forward, I'm not that worried about insufficient risk being taken. I mean, the numbers I saw may be a little outdated. I think they were in one of the IMF publications, is that, for example, U.S. banks went into the crisis with about 13% risk-adjusted capital ratios. Of course, if you raise the minimum, if you want to stay being well capitalized, you're going to have to be quite above the minimum, and that's one of the points. But I just think, there are risks on both sides, but I think the risk is far greater that you wind up with not enough capital. I mean, okay, this crisis is unusual. We're not going to have one of these every couple of years, but the alternative, if they have less and you have shocks, is that you put the public money in after a while. It gets harder to raise it in private, and then the rest of us pay for it. So I'm prepared to push for more, as I suggested earlier. That will mean lower leverage, slower asset growth. You'll pay a little something for that, but the question is, what do you want to pay for safety? I'm willing to pay. Pay more. If you look at the competitors, banks that are not benefits of the safety net, some of those have higher capital ratios. So I would, on balance, I think it's the way. I think it's the way to go.
We're at our witching hour, but I want to leave you with one poignant statistic about the crisis, which I picked up in New York yesterday. Walmart, like all the big retail chains, is reporting lagging sales, disappointing developments in consumer demand. But there is one item in the Walmart inventory of products for which demand is up 35% year over year. Safes. And that will give you an indication of the extent to which panic may begin to set in. Thanks to Morris. Thanks to the rest of the panel. Thank you all for coming.